name is Mark McVearry. I've been doing reverse mortgages for over 30 years, and during that time, I've helped thousands of homeowners. I know you see the commercials on TV and you wonder, is this right for me? What I want to try to be able to do during this webinar is kind of give you a good overview of how they work. Reverse mortgages, when they first rolled out, weren't perfect. No product is. But what's happened over the years is they've done a good job of making upgrades to them, changed a lot, made them much more federally regulated. So they're a lot safer than secure than the reverse mortgages of the past. So let's kind of jump into, what is a reverse mortgage? Basically, the most popular reverse mortgage out there is known as a HECM, which stands for Home Equity Conversion Mortgage. That is the federal version of a reverse mortgage, and it really dominates the market. There are some privately insured ones out there, but the majority of the time they're geared more towards the $1 million homes in that range, where the HECM is the most popular. Number one, that HECM is federally guaranteed and federally insured. But let's talk about a reverse mortgage in general. Basically, when you're doing a reverse mortgage, which a lot of people think, you're not giving away your home. That's one of the biggest misconceptions we'll talk about later. But when you're doing a reverse mortgage, you're borrowing money now and you're deferring the payment for the future. What you're going to pay back in the future is whatever you borrow plus interest. That's what creates what you owe. If you're familiar with a home equity line of credit, they're very similar, but the reverse mortgage doesn't require a payment. So in other words, you get a home equity line, you can draw on it as you need, but that on that home equity line, you got to make a monthly payment. But on a reverse mortgage, you can draw what you need as you need it, and you don't have to make a payment on it. There is no payment required. You can make a payment if you want, but it is not required. So basically, a reverse mortgage, a way to borrow money against your house without a monthly payment. And that money that you receive from that is not taxable. It's tax-free money. So let's talk about who qualifies for a reverse mortgage. Okay. Number one, at least one homeowner needs to be 62 or older. That's a requirement. Okay. Not both, but at least one. It has to be your primary residence. It can't be a vacation home. It has to be where you live. If you have an existing mortgage on the property, there must be enough money in the loan to be able to satisfy that current mortgage in full. Another thing is that when you look at income and credit, it's a lot easier to qualify for a reverse mortgage than it is for a regular mortgage. With a reverse mortgage, there are no minimum credit score requirements. So again, it makes it a lot easier to qualify for. And lastly, another requirement is that you have to attend a HUD certified counseling session. That can be done over the phone or it can be done in person. That is a guarantee that you know what you're doing when you're getting involved in the loan. Talked about some of the qualifying issues. Let's talk about what determines what you're going to get. Okay, there's really kind of three main factors here. One is age, and it's going to be the age of the youngest homeowner. So if you have a husband and wife, you're going to go on the youngest age. The older you are, the more you're going to receive. That's the bottom line. Other thing is the appraised value of your home. That's also going to determine it, and current interest rates. So again, to recap, the three things that are going to determine what you're going to get are going to be age of the youngest homeowner, appraised value of the property, and current interest rates. Those three determine how much money you're going to be able to borrow. So once we determine how much money is going to be available to you, there's a variety of different ways in which you can receive your money. You can receive it in a lump sum. You can have it set up in a line of credit. And actually that line of credit will grow to give you access to more money in the future. Or you can get it where you get a check each month, or you can mix and match any of those combinations. So, that's a place we spend a lot of time with when we're talking to clients is, okay, what's the best way for you to take your money? I would say the majority of my clients, you take the money in a lump sum in a line of credit. Usually they have something they want to get rid of right away, mortgage, some debt, or some things of that nature. They get that paid off, put that money back in their pocket each month, and then they use a line of credit for future emergencies or draws when their fixed income can't meet it. But again, you have those options. Again, lump sum, line of credit, a check each month, or a combination of all those. What are some of the things that people use the money from the reverse mortgage for? Probably the biggest one that I see is paying off existing mortgages, lines of credit. That's probably the biggest one. Reason being is this. A lot of people get into retirement. They didn't expect to have these monthly payments. And now that they're living on a fixed income, that payment's eating up a lot of their monthly income. So what they're doing is they're coming to me and saying, hey, Mark, can I get rid of that monthly payment using a reverse mortgage? So again, we use it to pay off the existing mortgage and the existing lines of credit, that way eliminating the payment. We also have a lot of people that come to us that want to use it to pay off credit card debt. I have a lot of clients that have used credit cards because their fixed income isn't meeting all their expenses. And what's happened over the years is those payments have kind of snowballed a little bit. So they come to me to use the reverse mortgage to pay off their credit card debt. Another thing is in-home health care. We see people use it because they don't want to leave their house and they want to use it for in-home health care. I have another thing that I help a lot of clients with is that maybe they're behind on the mortgage or in foreclosure. Maybe they're behind on the mortgage payments. Maybe they're behind on their homeowners association dues. Maybe they're behind on the property taxes. And when they're in that situation, it makes it very difficult to borrow on a regular loan. That's where we use the reverse mortgage because as I alluded to before, the income and credit restraints aren't as great with a reverse mortgage as they are with a regular mortgage. And probably, another thing that we see is people helping out their family members. Maybe a son or daughter, needs some money for anything, maybe just everyday expenses. Like I've had situations where maybe the kids lost their job or had some health concerns or, got a divorce or something of that nature. And, mom and dad want to help them, but they also don't want to put themselves in a position. So the reverse mortgage actually allows them to lend them some money because since there are no payments on it, they can give them the money while they're here and let them and see what they can do with it. And the homeowner's not going to take on that burden of a monthly payment. And also in that same line, helping out grandkids. I've seen people use them to help pay off, like help college debt, a lot of different things. I mean, it's your money to do whatever you want to do with it. Next thing I want to talk about are the common misconceptions on reverse mortgages. And there's a lot of them. There's a lot of them. I mean, as I alluded to before, I've helped thousands of people over the years. And I've heard it all. I've heard it all. The biggest one that I would say is the bank is going to take my house. They feel like, the whole reason that, people are in the reverse mortgage business is to take over the home. That is false. As I alluded to before, you are borrowing against the value in your home. You are the owner of the home. So, as long as you take care of making sure you're paying the property taxes and the homeowner's insurance and those items, the loan is good to go. So the bank doesn't want your property. What they're doing is they're going to lend you money and they want to get that money back when you no longer live there. And that kind of goes into the next thing. A lot of people think, oh, I'm not going to be able to leave this to my kids. You can still leave it to your kids. Again, you still own the house. You're just borrowing money against it. So when you're no longer there, your kids have a choice. They can choose either to keep the home or sell the home. What I see in most cases is the kids sell the home. They're usually living somewhere else and they're going to sell it, pay off what's owed, and keep the rest. If they want to keep it, they can refinance what's owed and keep the property. It's up to them. But you can still leave it to them. It's no different than if you had a regular mortgage on the property. If you had a regular mortgage on the property, the kids have to deal with that mortgage once you're done. Either sell it, pay off what's owed, or refinance it and keep it. Again, a reverse mortgage is just another way of borrowing money against your house. And again, it's the greatest thing about it is you can borrow money without a monthly payment. Another thing that I see a lot is people say, I could outlive my reverse mortgage. You can't outlive your reverse mortgage. Again, as long as you take care of the obligations of the loan. The obligations of the loan is live there as your primary resident, pay your property taxes, and take care of your homeowner's insurance. And if you have homeowners association dues or condo fees, you got to take care of them. As long as you do that, you can live in that house forever. The government guarantees it. This isn't a 15 or 30-year loan like a regular mortgage. It's as long as you live in the property loan. The other thing I hear is it's only for desperate people. That's not the case. I see all kinds of income levels take this out. Everybody has different reasons for doing this. So it could be for somebody who's, again, helping out somebody who might be behind. But there's a wide range of reasons that people do this. Another misconceptions are the fees are too high. They're no different than any other FHA refinance. Every FHA loan has similar fees. The one thing that people don't realize is this: you can finance the fees in the loan. You don't have to come out of pocket for the fees. So they can be financed in the loan. And I mean, what you have to look at in any situation, this is the cost, but what are the benefits that I'm getting from the costs? And I find with most of my clients is they'll look at the cost and they're like, okay, I understand why the costs are there, but what I'm going to get out of this is going to outweigh what the original costs were. Another question I get all the time: are reverse mortgages safe? Yes, they are. I mean, especially when you look at the federal HECM program. Number one, it isn't, a lender just can't make up their own rules when they do this. You have to follow the federal guidelines. So if I had two people living right next door to them, same house value, same age, same everything, they're going to get the same amount of money because the government regulates that. The government also guarantees that these are a non-recourse loan. And what a non-recourse loan means is this, is that if you ever got to the end and you ever did owe more than what the house is worth, you or your estate would not be responsible for that money. No other loan gives you that feature, but it's guaranteed under the reverse mortgage. You have to do FHA counseling. These guys are independent. These HUD certified counselors are independent. They don't care if you do this or not. So you have to go have a session with them, like I said before, either over the phone or in person, and they're going to issue a certificate that you understand what you're doing. And lastly, again, you still own the house. You're not giving up ownership. And I hear from people all the time, it's like, well, I heard somebody did a reverse mortgage and they got foreclosed on. Okay, let's get real. There's no payment to be made here. So there's no payment to miss. So it's not that reason. The only time anybody gets into any issues when they do a reverse mortgage is they don't take care of their property taxes and they don't take care of their homeowner's insurance. That's with any loan. If you don't do that, you can run into issues. I hope you found the information that I just went over helpful. I know I can't cover everything in this webinar, but what I want to be able to do is this: give you some basic information. And one other thing I want to say real quick is I know this loan isn't for everyone, but if it's not for you, maybe you have a friend, family, or relative that it might be useful. So you can ask them to actually come in, watch the seminar, and see if it's helpful. But if you need to get more information from me, you can always visit my site, markmcv.com, or give me a call. I can guarantee this: anytime you call me, you're going to speak directly with me and you're going to have access to my 30 years of experience where I can answer your questions. What I want to see people do more than anything else is this: call me, get the right information. That way you can determine if this is the right loan for you. If it isn't, great. But if it is, I'd be more than happy to help get it taken care of. Once again, I'm Mark McVearry, and thanks for watching.